2025 is shaping up to be a make or break year for crypto, and most people aren't ready for what's coming. Bitcoin has already surged past 100K. Institutional adoption is scaling at an unprecedented rate. And the US government has made game-changing moves that will shape how digital assets are used globally. While everyone is focused on price predictions, the real opportunities will come from macro trends, regulation, and the next major investment cycles that are set to dominate this market. We've already seen Bitcoin ETFs bring billions in institutional inflows, but that was just the beginning. Now, Wall Street is eyeing the next phase. Altcoin ETFs, AI-powered blockchain applications, tokenized real-world assets, decentralized infrastructure, and stablecoins becoming the backbone of global finance. At the same time, liquidity cycles are shifting, regulations are evolving, and governments are making their stance on digital assets clear. This isn't just another bull cycle, it's the start of something much bigger. In this video, we're breaking down 5 of the biggest crypto predictions that will define 2025 and beyond, and more importantly, how you can position yourself before the market catches on. By the way, if you're new here, my name is Danilo, and I cover everything crypto, from macro trends to deep dives on what actually matters. And if you want to stay ahead of the biggest shifts in the market, make sure to hit that subscribe button and turn on notifications. All right, let's get into it. For years, crypto has thrived in environments where liquidity was abundant. But in 2025, the macro landscape is more complex than ever, and the idea that easy money is returning might not be as certain as people think. While many expected rate cuts and a return to looser monetary policies, the Federal Reserve has held interest rates steady at 4.25 to 4.5%, with growing concerns that inflation may force additional hikes instead of cuts. The initial hope of an aggressive easing cycle is now being questioned, and markets are starting to adapt to the possibility that liquidity might remain tight for longer. The biggest unknown is how the US government's fiscal policies will affect liquidity. With proposed tax cuts, new tariffs, and aggressive spending policies, there is a growing risk that inflation picks up again, which could force the Fed to delay rate cuts or even raise rates further to maintain price stability. This could create a more volatile environment for crypto, where institutional capital rotates between Bitcoin, real-world assets, and stablecoin-based finance, rather than fueling an across-the-board altcoin surge. So, what does this mean for crypto in 2025? The biggest winners won't necessarily be the riskiest assets, but rather the sectors that offer sustainable adoption and real-world utility. Bitcoin will likely remain a dominant asset for institutional investors, while RWAs, stablecoins, and regulated DeFi protocols could see increased capital inflows as investors look for safer ways to gain yield and hedge against economic uncertainty. The idea of a, quote, liquidity-driven bull run is evolving. This time, it may not be about chasing the highest beta plays, but rather positioning in assets that can thrive even in a more selective capital environment. Institutional adoption is no longer a future possibility, it's happening right now. And 2025 will be the year regulation and investment strategies fully align to bring crypto deeper into the financial system. With the approval of Bitcoin ETFs in early 2024 and Ethereum ETFs following shortly after, traditional finance has established its foothold in the crypto market. But the next wave of institutional adoption goes beyond ETFs. We're now entering a phase where tax incentives, regulatory clarity, and blockchain integration into finance will redefine the industry. A major development fueling this shift is the confirmation from Eric Trump that US-based crypto projects will benefit from zero capital gains tax. This is a huge catalyst because it removes one of the biggest barriers for investment in digital assets, tax inefficiency. By eliminating capital gains tax for US-based crypto ventures, companies now have a strong reason to keep their operations within the US rather than moving offshore somewhere. This is expected to drive a wave of new blockchain startups, investment funds, and capital inflows as entrepreneurs and institutions take advantage of the more favorable regulatory landscape. And beyond tax incentives, we're also seeing a shift in how the US government is handling digital financial assets. The recent executive order on digital financial technology signals a move away from the restrictive enforcement-driven approach of previous years and towards a regulatory framework that supports innovation. This means clear rules for DeFi platforms, more structured pathways for stablecoins, and potentially an entirely new category of regulated digital financial products that traditional investors can access. Another key shift is how traditional financial institutions are integrating blockchain. More banks, hedge funds, and asset managers are developing blockchain-based settlement and trading systems, enabling them to move capital more efficiently while reducing costs. Instead of simply investing in crypto assets, institutions are now actively building on the blockchain technology itself. This combination of regulatory clarity, tax incentives, and institutional adoption is making 2025 a turning point for crypto's integration into traditional finance. We're shifting from an era of uncertainty to an era of measurable adoption, and that means the biggest investment opportunities will no longer be in high-risk speculative assets, but in projects that align with institutional money. Artificial intelligence is already reshaping industries, and in 2025, its intersection with blockchain will go beyond hype. It will become a core driver of digital finance, data security, and decentralized computing. While previous cycles focused on speculative AI tokens, this year is about real-world AI applications integrating with blockchain to create autonomous, secure, and scalable systems. One of the biggest developments is the rise of decentralized AI networks. Unlike centralized models controlled by companies like OpenAI and Google, blockchain-based AI models distribute processing power across nodes, creating an open and trustless ecosystem. Projects like BitTensor or Tau, SingularityNet, Ajax, and FetchAI, FET, are already leading this transformation, using blockchain to make AI networks permissionless, decentralized, and resistant to corporate control. As AI continues to advance, these decentralized networks could play a crucial role in ensuring that AI-generated content and decision-making remain transparent and verifiable. Another critical application is blockchain's role in securing AI data. With AI models requiring massive datasets to improve accuracy, data integrity and security are becoming serious concerns. Blockchain's ability to store immutable records ensures that AI training data is verifiable, unaltered, and resistant to tampering. This is particularly important in industries like healthcare, finance, and government, where AI-generated decisions need to be fully auditable. The Graph, GRT, and Ocean Protocol, or Ocean, are two leading projects working on AI-driven data indexing and decentralized storage solutions that could become essential for AI's next phase. The regulatory landscape is also adapting to this AI blockchain convergence. Governments are now actively working on policies to manage AI-powered financial systems, on-chain AI decision-making, and decentralized AI governance. The recent executive orders on digital financial technology are expected to play a role in defining how AI models operate within decentralized networks, ensuring that they comply with security standards while remaining censorship resistant. As we move deeper into 2025, AI's integration with blockchain won't just be a trend. It will be a fundamental shift in how digital economies operate. From decentralized AI networks to secure data infrastructures and AI-driven DeFi applications, this convergence will reshape the way we interact with finance, automation, and digital intelligence. Crypto has long been viewed as an industry separate from traditional finance, but in 2025, that narrative is changing. Real-world assets, or RWA, and decentralized physical infrastructure, or DePIN, are creating the bridge between blockchain and the global economy, opening the floodgates for institutional adoption and new financial applications. These sectors are no longer theoretical. They are being actively implemented by some of the biggest players in both crypto and traditional finance. The tokenization of real-world assets is already gaining serious momentum. Major financial institutions, including BlackRock, JP Morgan, and Franklin Templeton, are using blockchain to bring assets like treasuries, real estate, and commodities on the chain. This shift allows for instant settlement, fractional ownership, and greater liquidity, something that was impossible in traditional finance up until now. Recently, Dubai's Damak Group partnered with blockchain platform Mantra to tokenize over $1 billion worth of Middle Eastern real estate, making these investments tradable like any other digital asset. The key takeaway here is that institutions are no longer waiting for regulatory clarity. They are actively using blockchain today to optimize financial markets. Meanwhile, Deepin is revolutionizing how physical infrastructure is built and maintained. Traditional infrastructure networks, like wireless internet, cloud computing, and energy grids, are centralized, expensive, and controlled by a few corporations. Deepin flips that model on its head, allowing individuals to contribute resources such as bandwidth, storage, or energy, and earning crypto rewards in return. This creates a decentralized, incentive-driven system that removes inefficiencies and makes infrastructure more resilient. One of the best examples of Deepin in action is Helium, or HNT, which has built a global decentralized wireless network by incentivizing users to provide coverage using Helium hotspots. Instead of a single telecom company owning the network, it is powered by thousands of independent contributors who earn crypto for supporting it. Similarly, projects like Render, or RNDR, are decentralizing cloud computing by allowing users to contribute GPU power for AI and digital rendering applications. With the explosion of AI, demand for decentralized compute power is increasing, making Deepin a crucial piece of Web3's evolution. The integration of RWA and Deepin is rapidly shifting crypto from speculation to real-world utility. Institutional money is already flowing into tokenized assets, on-chain treasuries, and DeFi applications connected to real-world finance. At the same time, Deepin is creating self-sustaining networks that remove inefficiencies in global infrastructure. These two trends are laying the foundation for a fully tokenized financial system, one where assets, infrastructure, and services operate on blockchain rails rather than outdated centralized systems. For years, stablecoins were just a niche part of the crypto economy, but in 2025, they're becoming the backbone of global finance, and the US government's latest decision has ensured that stablecoins, not CBDCs, will dominate the future of digital payments. In a massive policy shift, Trump's recent executive order officially banned the creation of a central bank digital currency in the United States. While many governments, including China and the European Union, are pushing ahead with state-backed digital currencies that could give central banks greater control over transactions, the US is taking the opposite approach, betting on private stablecoins instead. This is a huge win for stablecoin issuers like Circle, Tether, and PayPal, as it signals that the US sees stablecoins as the preferred alternative to government-controlled digital cash. Without a CBDC, demand for stablecoins will only grow, as they become the primary way to move money on-chain, power DeFi, and facilitate global transactions. The total stablecoin supply has more than doubled in the past year, exceeding 400 billion, as both retail and institutional adoption accelerates. But the biggest shift is that traditional finance is no longer fighting stablecoins. Major institutions are integrating them. Visa, PayPal, and JP Morgan have all launched their own stablecoin-powered payment and settlement solutions, recognizing that stablecoins allow for instant transactions, reduced fees, and seamless cross-border payments. Visa's tokenized asset platform, or VTAP, now helps banks manage fiat-backed stablecoins, showcasing that stablecoins are no longer a crypto tool. They're becoming a fundamental part of traditional banking infrastructure. The global regulatory battle over digital money is heating up. The European Central Bank is pushing forward with a digital euro, arguing that government-backed money is necessary to compete with US dollar-denominated stablecoins. Meanwhile, countries like Hong Kong and Singapore are creating frameworks that regulate stablecoins but allow private sector issuers to dominate the space. With the US firmly rejecting a CBDC, stablecoins are now positioned to become the dominant force in global digital transactions. Instead of being controlled by central banks, the future of digital money is being shaped by private stablecoin issuers, DeFi protocols, and blockchain-based payment networks. This means that in 2025, and beyond, stablecoins won't just exist within crypto. They will be a fundamental part of the world's financial system. As we move deeper into 2025, one thing is clear. Crypto is no longer just a speculative asset class. The combination of institutional adoption, regulatory clarity, technological innovation, and macroeconomic shifts is pushing the industry into a new phase of legitimacy and global integration. The biggest takeaway? The opportunities in crypto are no longer just about speculation. They're about being positioned in sectors where institutional money is flowing. In previous cycles, hype alone drove markets, but now, the biggest gains will come from assets with real adoption, regulatory clarity, and deep liquidity. So now, I want to hear from you. Which of these predictions do you think will have the biggest impact? Are you most bullish on AI, RWAs, stablecoins, or something else entirely? Drop a comment below and let's talk about it. If you found this breakdown valuable, make sure to like, subscribe, and turn on notifications so you don't miss the next big market shift. I'll be covering these trends in real time as they unfold, so stay tuned. Thanks for watching, and I'll see you in the next one.